Okay, now we're on to chapter 13, and chapter 13 really is something that you probably will find very useful because it's going to be using differential analysis to making decisions. Now, what is differential analysis? Differential analysis is just looking at, okay, here's the way it is. If we were to change this, what what would it look like? And what would be the difference if we were to buy a new machine to improve productivity? What do we need to look at to make that analysis? And what you need to do is identify relevant and irrelevant costs and benefits in the decision. So, what you're really trying to identify are, if I stopped this action, what would be the difference in my sales? And what would be the difference in my incremental cost? So, I don't want to take into account things that have no bearing. For instance, maybe you have manufacturing overhead that none of that would go away. So that's not even a factor in your decision. So there are six key concepts. Number one, every decision involves choosing from among at least two alternatives. So you'll have option A, option B, maybe option A, B, and C, and A would be continue as we are now. For instance, let's say that you have an air conditioner that is old, it's 10, 15 years old. And so going forward, what are the cost differences going to be? Well, on your existing, you probably use more electricity costs and you may have more maintenance costs. So going forward, you would say those are the costs. And then you would look at replacement would be, well, what is it going to cost out of pocket? And then how much am I going to save in utility costs? How much am I going to save in repair costs? And then you would kind of do an analysis and determine probably when it is, how many years it would take you to recover your investment. Plus, if something's 15 years old, eventually it's going to die. Key concept two is you only want to know to focus on the future costs and benefits that differ between the alternative. Everything else is irrelevant and should be ignored. So again, you're only looking at differential costs. What is the difference between my current cost structure and my new cost structure? Or future revenues, differential revenue. How much revenue is going to increase, or am I going to lose revenue? And is that going to be offset by the decline or the decrease in the amount in the cost, the incremental cost? So the incremental cost is an increase in cost between two alternatives. An avoidable cost is a cost that can be eliminated by choosing one alternative over the other. So, in the example of uh, air conditioning, the avoidable cost would be obviously the cost of a new unit, but it can only be avoided for so long. Sunk costs are irrelevant when choosing among alternatives. A sunk cost is a cost that has already been incurred and cannot be changed regardless of what a manager decides to do. My wife and I like to go to plays at TPAC. And so we buy the tickets ahead of time. And so when it comes down to deciding whether we want to go, maybe something comes up, or maybe the play is not really one that we are crazy about, we can't get our money back unless we can sell that ticket. So if you can sell the ticket, then that is a relevant cost. But if nobody wants to buy that cost, it doesn't matter. What matters is we've already paid that cost. We're not going to get it back. So, you know, it's some costs. Number five, future costs and benefits that do not differ between alternatives are irrelevant. So, for instance, if Option A, you still have maintenance costs of $100,000, and option B, you still have maintenance costs of $100,000. That's irrelevant. They both, it's not incremental. It doesn't change the picture. And then opportunity costs need to be considered. So opportunity cost is what is the best alternative? What can I do instead of this option? And what is the opportunity cost of not doing that? So in this example, we're considering a new labor saving machine that rents for $3,000 per year. So the current situation, sales of 200,000, sales would not change, so there would be no incremental sales change. Direct materials would be the same, direct labor would decrease. So we would save $15,000 of direct labor uh, by renting this new machine. Variable overhead wouldn't change. So the contribution margin would increase with the new machine. Then we add the fixed cost. So the fixed cost, nothing would change. Our fixed cost would stay exactly the same. We would see an increase in rent of $3,000. So the differential is that our operating income would go up $12,000 just by looking at the incremental cost. And so we can effectively analyze the decision by looking at the different costs and revenues and arrive at the same solution. So in other words, we would benefit from a $15,000 reduction in labor costs. That would be offset a little by the rent of the machine, but we're 12 grand to the good. Using a differential approach is desirable for two reasons. Only rarely will enough information be available to prepare detailed income statements for both. Mingling irrelevant costs with relevant costs may cause confusion and distract attention away from the information that is really critical. So we only want to look at the differences. It's more concise, it's not as complicated, it's not as busy. Prepare an analysis showing whether a product line or other business segments should be dropped. One of the most important decisions is whether to drop a business segment. Is it losing money? To assess the input, its net impact, it's necessary to carefully analyze the cost. So Louisville company makes digital watches, with smart watches and everything. It's just no longer as profitable as it used to be. In fact, they haven't reported a profit for several years. And they want to decide whether we should drop this. They should drop the digital watch segment only if its profit would increase. So we're going to compare the contribution margin that would be lost if the digital watch line was discontinued to the fixed expenses that would be avoided if the line was discontinued. So if we got rid of the revenue and sold or shut down the division, what cost would be eliminated? Here you see that sales would be off by 500,000. So our contribution margin currently is $300,000, but our costs are $400,000, a net operating loss of 100,000. So which of these costs would go away? And will there be enough to offset? Well, let's look at the next one. So an investigation revealed that the fixed general overhead and fixed general administrative expenses would not be affected. So we would not reduce any of those costs. The fixed general factory overhead and general administrative expenses would be reallocated to other product lines. So again, no decrease in those costs. The equipment used to manufacture digital watches has no resale value or alternative use. So it's a sunk cost. And basically, we're depreciating that. However, since we've already purchased the equipment, we're going to look at this on a cash basis. We will continue to have the depreciation expense. However, it's a non-cash expense. So we're not going to factor that in. So we would lose $300,000 of contribution margin. We would eliminate the salary for the line manager. He would lose his job, he or she. We wouldn't need to advertise anymore, and we wouldn't need the rent on the factory space. So we'd save $260,000 in expenses, but we'd lose $300,000 in contribution margin. So if we were to do this, we would be $40,000 worse off. So when a company is involved in more than one activity, it's vertically integrated. So this is going to be a make or buy decision. Uh, Advantages: smoother flow of parts and materials, better quality control, and you do realize some profits. Companies may fail to take advantage of suppliers who can create economies of scale. So a larger manufacturer may be able to do it cheaper because they're more efficient. While that's a factor, company must be careful to retain control over those activities. So if you get it for a cheaper price, but then you don't get it on a timely basis, that's not good. The sourcing, okay, so direct materials are 9, direct labor 5, variable overhead 1, depreciation of special equipment 3, supervisor salary 2, general factory overhead 10. So these are allocated costs. So special equipment used to manufacture Part 4A has no resale value. So we couldn't get any income from that. The total amount of the general factory overhead, which is allocated on the basis of direct hours, would be unaffected. So we wouldn't eliminate any of those costs. 30,000 unit product is based on 20,000 parts produced each year. So an outside supplier can produce those 20,000 parts for $25 a piece or $500,000. So if we look at the make versus the buy decision, the direct materials cost us 180,000, the direct labor 100,000. We do have 20,000 of variable overheads. So these would go away if we no longer made it. And the supervisor's salary um, would go away as well. But the overhead would just be allocated to somewhere else. Depreciation of equipment, it's a sunk cost. It's there, we can't sell it, so it's not really a factor. So we would have that depreciation whether we um, use the equipment or not. So it costs us really, our fully allocated basis is $30 or $600,000, but our actual out of pocket expenses are $340,000. So to me, it's clear you should make it. Plus, you get all of the benefits of the control. Opportunity costs, again, they're not actual cash costs, but it's just a foregone benefit. So we have a certain amount of money to invest. We're going to invest it this way. And by investing it this way, we could invest it that way. And we want to know which way gives us the most bang for our buck. Compare an analysis showing whether special orders should be accepted. So you're a manufacturer and basically you have capacity. So you have a company that has a one-time order. It's not going to affect your sales price. I mean, if it was a customer that was in your normal area and they were going to buy, it may affect the price you can charge others. But this is a special order, and for whatever reason, it isn't going to impact anything else. So the only items we really need to look at are the incremental cost and the benefits. The existing fixed manufacturing overhead costs would not be affected. Okay, we've got the building, we've got the equipment, we've got the manager, etc., and aren't going to have to expand our building. We're not going to have to hire additional managers, etc. So Jet makes a single product whose normal selling price is $20 per unit. A foreign distributor offers to purchase 3,000 units for $10. So that's half of their normal selling price. But what we really want to know is what is it going to cost us? What are the incremental costs of producing these 3,000 units? It's a one-time order, one-time deal. Our capacity is 10,000 units, but we're only at 50% capacity. And even with this, it only brings us up to 80% capacity. Should Jet accept the offer? So the revenue, of course, um, this is the revenue and the variable costs. And so this is the income statement for Jet Inc. based on their current production of 5,000 units. If we accept the order, what is going to be our incremental revenue and what is going to be our incremental cost? So again, we make $12,000. And so we're going to get $30,000. So what are the incremental costs? The only incremental costs are going to be the variable cost of $8. Okay. $8 variable cost. That's direct material, direct labor. There will be no marketing cost. There'll be no, the manufacturing overhead will just be spread a little wider. So even though we're selling this for half of what we normally sell it for, we would have a 50% increase in our profit. Quick check one. They ordinarily sell the excellence for $50. The variable production cost is $10. Fixed production cost is $18 per unit. Variable selling cost is $1. Customer has requested a special order for 10,000 units. The special order will not involve any selling costs, but Norton Optical would have to purchase an imprinting machine for $50,000. So what are our incremental costs? Well, you've got to purchase equipment for $50,000. That's going to be a cash expense. You would depreciate it, but if this is a one-time deal, you're not going to use that equipment anymore, most likely. Maybe you would, maybe you would open your market. So what we need to do is we've got cost of $10. So in other words, below what is a rock bottom minimum price below which Northern should not go in its negotiations with the customer? In other words, below what price would Norman Optical actually be losing money on the sale? And it's 15, and that is the $100,000 variable production cost, which is the $10 times 10,000 units, so that's 100,000. And then the 50,000 for the equipment. So our relevant cost would be 150,000. So our break even is going to be $15. All right, another decision. This is okay, what should I produce? I've got a couple products. Which one should I produce? In these situations, companies must trade off or sacrifice production of some products in favor of others to maximize profit. The key concepts here is when you have a limited resource and it restricts the ability to satisfy demand, that's called a constraint. And the machine or the process that limits overall output is called the bottleneck. It is the constraint. So determine the most profitable use of a constrained resource. Fixed costs are usually unaffected in these situations. So the product mix that maximizes the company's total contribution margin should ordinarily be selected. So we have product one and product two. And it looks like we have a current demand of 2,000 for product one, 2,200 for product two. Contribution margin is 40% for product one, 30% for product two. So based on that, you would think product one would be the one. However, we make $24 on product one, which is higher than 15, but it takes us a minute to make it. Whereas here, it takes us half a minute, so we can make two of these in 1 minute, which is $30. So A1 is constrained resource and being used 100% of capacity. There's excess capacity on all other machines. So machine one, A1 has a capacity of 2,400 minutes per week. How many units of each product can be processed through A1 in 1 minute? So we know product one is 1 unit and product two is 2 units because it takes half a minute. So which generates more profit for the company? Product two, because we can do two of those, and even though the margin is $15, 15 times two is 30, so that would be the product. So we should emphasize product two because it generates a contribution margin of $30 per minute. So we should produce all that we need for product two, and then anything left over we'll do product one. So time available is 2,400 minutes. Time used for product one is two, so that's 1,100 minutes. So we've got 1,300 minutes left over. So we're going to produce 1,300 units of product one and 2,200 units of product two. So now the contribution margin is 64,200. Now we're constrained, so increasing the capacity should lead to increased production and sales. How much should we be willing to pay for an additional minute of machine time on A1? And we would be willing to pay up to $2,400 per minute. I mean, if we are 24, probably will not because then we wouldn't make any money. But we would be willing to pay up to $24 a minute because that's our margin. And just going to go through a similar type problem. All right, so managing constraints. It's often possible for a manager to increase the capacity of a bottleneck by either working overtime, subcontracting some of the work, buying additional machines, shifting workers from the non-bottleneck process to the bottleneck, focusing business process improvement efforts on the bottleneck, and reducing defective units. So again, you have joint products. So we are going to process this up to a split off point. And we can either sell at that point or continue to process. Petroleum is a product like that. So you have factories that will just produce it up to the split off point, and you'll have factories that then produce oil with petroleum, gasoline, and chemicals. And so you have a separate processing. The joint costs are typically allocated among different products at the split off point. A typical approach is to allocate joint costs relative to the relative sales value at the end product. But that could be very dangerous, okay? Joint costs are irrelevant in decisions regarding what to do with a product from the split off point forward. What we're concerned with it is what is our incremental profit and what is our incremental cost? What are our incremental costs? Sawmill cuts logs from unfinished lumber, and sawdust are the immediate joint products. Unfinished lumber is sold as is or processed further into finished lumber. Sawdust can be sold as is or processed into presto logs. And so we're going to look here at the sales value of the split off, and then we're going to look at the sales value after the split off. And so we've got 270 minus 140. So we're going to make $130 revenue from the split off. We don't care about this. Those costs are already embedded. So what we're looking at is 130 minus the 50. So we're going to make $80 on the lumber. The sawdust, though, is $40. We'll get an additional $10 if we process it. but our processing costs are 20, so we would end up losing $20. So we should process the lumber, sell the sawdust. And then ABC can be used. People have a tendency to assume that if a cost is traceable to a segment, then the cost is automatically avoidable, which is untrue. So that is chapter 13, and it's really useful. You can see that these are real life, real company decisions. Um, but the importance here is that you're only looking at the difference. All right. What would be the difference in revenue, and what would be the difference in cost? What are the true costs that would be eliminated if we were to eliminate a division? And what are the costs that we would incur if we added another product?